Hello and welcome back to the Argyle CFO Leadership Forum. My name is Brittany Sullivan with Argyle, and it's great to have everyone joining us today. I would love to introduce our keynote speaker, Simone Grimes, Chief Financial Officer at Acadia Insurance. We are excited to have Simone with us for a keynote titled CFOs and ESG, Creating a Sustainable Future. Welcome, Simone, and over to you.
Thank you, Brittany, and welcome to everyone who's here today. So a little bit about me. I am the CFO of Acadia Insurance, which is part of the Berkeley company. But I do want to explicitly say that I will not be discussing anything specific to WR Berkeley, nor representing its views, ESG strategies, or goals. So nothing I say should be interpreted or constructed as such. Our official position is clearly articulated in our annual sustainability report. But now just to speak a little bit about more about me. So this is a topic I'm very passionate about. I studied sustainability investing at Columbia University and ESG governance for the board of directors with National Association of Corporate Directors. I've worked with 3 public companies now and their boards to develop ESG frameworks, identify and measure ESG metrics to include scope 1 and 2 emissions, and to report out via annual sustainability reports. So I would love to know who's in the audience. Next slide. And just so you know, there is a bit of a time delay between when things move and when I'm speaking. So just be a little patient with that. But so there is a poll that's coming out to you, and essentially it'll be just helping me understand and helping each of you understand who's in the audience today. So the polling questions that are coming to you are on this slide. And you'll just kind of respond to them. And when the poll is ready, I'll see the results. Thanks so much. Next slide. So our goal today is to talk about sustainable future and specifically how to leverage common frameworks, what successful ESG progress looks like and how to measure these efforts, as well as understanding the use of credits and incentives to meet ESG goals. So those are our objectives today. And next slide. But before we really kind of dive into the topic of ESG, I think it's very important to take a step back and really understand where we are with this topic right now. Because a year ago, this presentation would have been slightly different, and that's because it is still in flux. And so what that means is that it's, gained a lot of ground, but at the same time, there have been a lot of pushback recently. And so what I'm showing you here is some articles, recent articles from reputable publications, Bloomberg, Forbes, Wall Street Journal, that really kind of archives the change in temperament that we're kind of noticing. So, first of all, I'm sure everyone knows this, but I'll just say it anyway. So in ESG, the E is for environment. And so that's really about a company and how it operates relative to the environment, as well as any commitments it's making with regards to carbon emissions, et cetera. Social, the S is for social, and that really is about human rights and equity, as well as an organization's relationship with its people, policies, actions, impacts, groups, and societies. And then G for governance is really about decision-making, including the rights and distributions among different participants and corporations, but it does have a very heavy focus on the board, the corporate board of directors. So kind of what's happened in 23 and going into 2024 is there have been a lot of retreats. So I'm going to talk about the major players, but I will start to mention some of them now. So BlackRock, which is one of the largest asset managers, they really retreated from their position on ESG. There was a delay. SEC has had some proposed climate rules for a while. Those still have not been published, with the exception of an update on greenwashing, which I will discuss. There's been a decline in investment in ESG funds. And most importantly, ESG litigation is on the rise. And so what that means is that private litigants and sometimes government agencies who do not really agree with the underlying premise and philosophies of ESG have been taking organizations to court, including NASDAQ, including proxy advisory services firms, in addition to bringing some companies in to talk about it in Congress. So this was especially true in the aftermath of the US Supreme Court's recent decision in Students for Fair Admissions versus Harvard, which had an outcome in which the consensus of the court was to endorse race neutrality in college admissions. And while that does not apply specifically to businesses, it has been appropriated by private litigants to challenge corporate entities who previously were adopting under the theory of the S and the G, kind of a diversity, equity, and inclusion effort. So that's really where we are today. So I want to at least start with that premise. I am going to go through what ESG means, but we just always have to understand the landscape we're operating in. It is constantly changing, and something to, if it's a topic you really care about, and you're part of an organization that has this charge in some form or fashion, it is important to maybe set some alerts and become, get clear on what's continuously changing. So I do have the results of the poll. And so what I'm seeing is that the majority of the audience participants today do not work with a SEC registrant or otherwise publicly listed company, but 30% do. The majority of participants are not working with a company that's disclosing scope 1 and scope 2 emissions. The far majority, 92% of participants are not working with a company that's been rated by an ESG rating agency. And I am going to later include a link where you can actually look up to see if your company's been rated. And in terms of industries, we are primarily looking at banking, insurance, and reinsurance, followed by manufacturing, and last, coal, oil, and gas. While we go through this presentation, the chat is going to be, there's a question feature, so you can put questions in real time. As I see them, I'll respond to them. So if there's anyone in the audience who's maybe represents a broker of carbon offsets, or in one of the companies that offers kind of for purchase carbon emissions reduction strategies or assets, please let me know that as well. Okay, thank you. Anyway, thank you all for being here today. Okay, next slide. Okay, so we've talked about the current climate, but I do want to get into why companies measure and even report on ESG. So if it's so great, then why isn't everyone doing it? Why is there backlash? Why are there lawsuits? And the reason is, first and foremost, there's always a cost benefit. So the cost of measuring, reporting, maintaining, adopting programs to support, and I'm going to stick with the E for now in ESG, is expensive. It requires new teams to be deployed and developed, perhaps new technologies to better measure emissions and other GHG factors. And so it's expensive. And then, to be quite frank, climate risk really hasn't been adequately priced by the stock and bond market. So when I first started and talked about how kind of investments are declining, it's one of those things where, because people socially and conscientiously believe that we should be doing something better for our planet, there's also that corresponding need to see a return in the portfolio. And the actual proof that assets that are primarily, kind of the new standard is going to be 80% in kind of, I'm just going to call them green investments for now. Are we able to see that they perform equally and or superior to other types of stocks, equities, or bonds. And that really has yet to be fully proved out. So that value add is still up in the air. Next slide. So with that said, companies primarily report for two reasons, because they want to, or someone's making them. So we just talked about how it's expensive to report. So companies that want to, generally speaking, are companies whose mission, ethos, and values, their competitive advantage, or it's profitable, meaning that they are actually producing carbon market offsets that are contributing to their bottom line, or because they are in an industry where risk management of climate risk is hugely important. In terms of someone making us, generally speaking, we'll look at regulatory requirements. However, in the US, we're seeing the pressures are coming more from other spaces. So investor demands, your large institutional investors, stakeholder expectations. And so that comes through in the press. Let's just talk about that. You know, it's kind of a move of the country and a sentiment about what's right, as well as activist investors and proxy advisory firms. Those would all kind of get into stakeholder expectations, and then risk management. So next slide. So here's some companies that are really engaged in ESG, and because they want to. It is part of their brand. It is part of how they operate. And, you know, here's a few examples. So Unilever and Patagonia have made sustainability a key differentiator. You know, Patagonia, once a jacket's sold, you can go back, turn it in. Unilever is a multinational consumer goods company that's integrated sustainability into its core business strategy. They focus on sustainable brands, such as, and the brands that they acquire, they ensure that they now start to give that sustainable brand feel. So like Dove, Ben & Jerry's, which resonate with consumers who prioritize those type of ethical and sustainable products. So for them, it's profitable. Patagonia as well, I just mentioned kind of the Coat Give Back program, but they also are strong. Their strong ESG positioning attracts customer. So if you think about their products, it is largely geared to people who really like the outdoors. And so there's a huge connection to wanting to partner with a company that values the environment. Tesla is one that is profitable because of it. So number one, it is their brand. It is, you know, they were among the first to the market with EVs. But aside from that, they have been profitably generating revenue from the sale of carbon credits for 12 consecutive quarters. As of Q3, carbon credits represented 29% of net income. So it's not insignificant. And then South Pole and Natural Capital Partners, that is their business. They're either climate solutions providers or they provide and sell and trade carbon offsets and consulting services. So it's their core business. Next slide. So when we get to who is making companies, this is where it starts to get very different depending on the industry you're in, where you're geographically located, whether you are or are not an SEC registrant, but we are going to go through that. So this is a busy slide. Next slide, sorry. This is a busy slide, but I think the main thing to take away from here is that based on your geographic location of the primary entity, the company, you have different regulations. And so for global companies, this starts to become a tricky landscape to navigate, whereas the US would be considered more of a laggard in terms of adopting more aggressive ESG rules. The UK, Europe, and other countries are far advanced. And so to the extent that you have operations in those geographical areas, then a lot of time, energy, and cost is going to be spent in understanding how to comply in that region. How does that track what the US is proposing, so the proposed rules, and where can you get some synergy so that you're not duplicating and having to replicate the effort it takes to report. Now, the most the standard is on everyone's mind right now is CSRD. So that's Corporate Sustainability Reporting Directive. It became effective in 2023. And as of 2024, it will apply not only to companies in the EU, but also US companies that are listed on an EU regulated market, and a few other qualifying criteria, have more than 500 employees, et cetera. They will have to start to comply in 2024. And why that's important is because the requirement under this rule provides such that, whereas right now most companies report in a separate, a US company will report their earnings and their management discussion analysis and their 10K, and then they'll issue a separate sustainability report. This is going to require some combining. And part of the standard is that just having a separate sustainability report is not going to be enough. By 2025, all US companies that are large and listed on EU regulated markets will have to continue to report, plus US companies that have large EU-based subsidiaries, regardless of whether they're listed on an EU regulated market. So again, a lot changing in that space, and a lot for companies to begin to have to adapt. I'll go a little bit more into that one when we talk about standards, but I do want to flip to just a few other things that are changing. So if you look at the left side, first of all, just from an eyeball perspective, you can look at everything on the 3/4 to the right of the slide and see that there are far more rules than on the left side. And the left side is the US, but there are some. That really goes back to the fact that there have been proposed rules for a while that have not actually been made final rules. So a few to note, though, is that NASDAQ has had a board diversity rule in place since 2021. However, it was challenged in court in 2023, and the court upheld NASDAQ's current rule. So again, if you're someone who's following this, it's something to be watched. One court upheld it, doesn't mean the next one will, but essentially what NASDAQ requires is companies who are listed on NASDAQ have at least one director who is identified as a female, a member of an underrepresented racial or ethnic minority, or LGBTQ+ by end of 2023. And if that's not present, you have to explain why or why not. Also, most companies generally will need to have 2 diverse directors to satisfy the requirement by 2026. So going back again to that court ruling, which was initially meant, we'll never know what the broadest implications were meant, but it has been, and this is the case versus Harvard, where the end decision was race neutrality. This would be one that you would expect to start to see challenged. In December of 2021, there was a Waiver Forced Labor Prevention Act called UFLPA. And what that really does is this would fall under S, ESG. It's really establishing that US companies can no longer import goods, wares, articles, merchandise mined, produced, or manufactured wholly or in part in Xinjiang by the Xinjiang Uyghur Autonomous Region of the People's Republic of China. And that is because the US determined that unless a company can really provide clear and convincing evidence, then the assumption is that the goods were produced using forced labor. And then in California, not new, but there are different rules if the company is domiciled in California and has over 1 billion in revenue. So there are enhanced scope 1, 2, and 3 GHG emission protocols. Next slide. Okay, so we're talking about who's making us. And so I did mention that the SEC had not finalized the majority of the proposed rules on ESG. However, they have put forward a rule on greenwashing, and that is really about That is really about green assets. So these are investment funds that advertise themselves as being sustainable. And what's happened in recent years is that the SEC has been going out and examining them and finding, you're just using that word and it's not, you're misleading the investors. And so in 2021, there was fines charged against Bank of New York. Small fines, though, it's just to send a signal. But this year, or last year rather, in September, the SEC approved amendments to the names rules, and they did fine Deutsche Bank 25 million. So that is a big change in terms of the type of enforcement that we're beginning to see. Okay, next slide. And I'm going to look at the questions because I'm starting to see some. It says, in the pursuit of minimizing carbon footprint, what challenges do finance leaders commonly face and how can they overcome these challenges? The biggest challenge they're going to face is that there is no firm regulation requiring them to do so. So to reallocate dollars to that initiative, you need to have a clear and compelling reason. You do have to realign your internal financial structure, and you have to adapt tools that can adequately measure the scope 1 and 2 emissions in a way that's reliable and withhold scrutiny. But you're also going to be challenged with, am I doing something that complies with one set of standards if you're like a global company and doesn't comply with standards in another state? Okay, I'm not going to go into this because you can look this up on your own. There's a business roundtable. They really redefine the purpose of a corporation, moving from shareholder primacy to benefiting all stakeholders. Next slide. In terms of who's making us, now this is more important for US companies. Who's making us it's the forces coming from influential proxy advisory services firms. So that's ISS and Glass Lewis, and their scope and reach and influence is enormous. They are the biggest. And so large institutional investors, regular investors, they rely on the recommendations by ISS and Glass Lewis, and that determines how they vote during proxy seasons. You also have large institutional investors, BlackRock, State Street. Again, I would say if you look at those companies and see what their stance is today versus a year ago, there has been a bit of a clawing back. And activist investors. Activist investors are investors who challenge a company. And they don't have to own a majority of the shares, but they challenge a company and can really require the board to completely change its composition. The most famous are Carl Icahn, Bill Ackerman, Nelson Peltz, and Daniel Loeb. Next slide. Here's an example where activist investors challenged ExxonMobil, and they were able to, and this was engine number 9, which at the time was not one of the famous activist investors, but they were able to successfully secure 3 board seats of ExxonMobil because they did not believe that the existing board was taking the environment seriously. So again, activist investors, proxy advisory services firms, large asset managers in the US, this is really who's driving most of the change. Next slide. So how are companies implementing? And let's go to the next slide real quick. So the most common frameworks that are in use right now are TCFD, GRI, and SASB. And there's some pros and cons of each. And with organizations, I'll just be frank, TCFD and SASB are used the most. And they do provide specific industry standards. So for example, if you're in manufacturing versus a beverage company, this is SASB now, versus insurance versus something else, they will give you standards of exactly what you need to be looking at and what is important in the supply chain. So scope 1, 2, and 3 emissions really speak to emissions the company is producing, emissions that upstream and downstream vendors are and users are producing. And so it really does require much more specificity about what needs to be considered in the ESG reporting framework. Okay, let's go to the next slide. Oh, I'm sorry. Let's go back one. I'm sorry. It's not included here, but I did say I was going to give you a little bit more information about CSRD because that is the most prevalent one at the moment. So that really is going to replace and significantly broaden the scope for companies and sustainability reporting requirements. It is going to incorporate sustainability with financial reporting. That's why they don't want to see the sustainability report sitting elsewhere. It's going to have a double materiality standard. Reporting is going to have to be aligned with year end, so like your 10K. It's going to require digital tags, limited assurances, and the audit committee has to be responsible. So this is a new reporting standard that will go into place, as I mentioned, at beginning this year. Okay, next slide. What is the biggest mistake that CFOs make when gathering insights, data, and reporting on key ESG metrics? So with the key ESG metrics, well, I'm going to say a few things. So in the US, there has been there was a big wave of moving towards really wanting to make broad promises and say, we're going to do this by, there was a lot of pressure with the Paris Accord to say you're going to be net neutral by 2050. And then, many companies, some of them say CFOs and companies align the two, made promises of what they were going to do in the future. Now, when those rules did not come into place, and when you're starting to find that the third-party forces are really backing off of that, you've made forward commitments that may no longer be applicable. So I think what's most important is to be paced and measured with this. A company internally can begin to become more aggressive, but in terms of what you're disclosing to the public and committing to, I think it makes more sense to wait to see what the final rules say, and then ensure that you comply. The other thing is ESG reporting should not be an exercise where you're creating a story. ESG, how you're reporting it externally, as long as it is what you are truly reporting internally, is not a huge lift. So I think that's important. I am getting a warning that we are going to be slightly out of time. So I am going to whiz through. Let's skip two slides. Okay, I'm sorry. The slide you're at right now. Go back one. If you're wondering if your company is reported, you can go to MSCI, plug in their name, and you can find their report. Let's skip forward 2 slides. One more. I'm sorry, one more. This is going to be an example of MSCI and what an ESG rating looks like. The company that I was using as an example is BP. And I would encourage you to read their sustainability report. They are one of the companies that made that net zero commitment. I would say that for operators in the oil and gas industry, there was much more pressure to make that forward commitment. So they are kind of considered in that space as being on the side of really having been a good example of a company responding to ESG. Okay, next slide. And next slide. Okay, so what are credits and incentives? Essentially, there are markets where carbon allowances are bought and sold and can be used to either offload the carbon emissions from your company's, I'm going to call it balance sheet, but just from its portfolio to another company. And you can also buy carbon benefit from other companies. So this has become a market, and it's indexed and there's pricing. Next slide. This really talks about what it is. Okay, so offsets or carbon credits essentially are the idea that a company can like plant a tree somewhere and then sell the carbon benefit that that tree is producing, will produce, and sell it to someone else. And then another company can buy that and say, hey, my emissions are really high, but because I bought these carbon offsets from another company, in net, they're less. I will say that when it comes to investors looking at this is kind of one of those things that's frowned upon when there's an over-reliance on offsets to bring down your carbon footprint as opposed to the actual activity of the company. I believe we are running out of time, and let's just leave this next slide up so people can see it as we kind of tune out. I am going to put my contact information in the chat. I always respond to people when people contact me and have questions after the fact. I'm more than happy to engage, and it's been a pleasure to spend this afternoon with you.
Excellent. Thank you so much, Simone, for such an insightful presentation. That is all the time we have for questions, but we will be happy to share any questions with you that we did not get to. I also want to thank everyone who joined us today. This session, along with all of today's content, will be made available on demand following the event. Thank you again, Simone.
Thank you.